John, on the data, it's hard to get a clear picture with the government shut down and not all the data releases coming through. But this morning, industrial production very strong, consumer confidence pretty weak. What is the data telling us?
Well, I think what it does tell us is in terms of industrial production, we're doing remarkably good compared to some of the regional Fed indexes on manufacturing that we'd seen earlier in towards the end of last year. In terms of the consumer, the one thing is the Michigan sentiment has been substantially lower than the conference boards for a long time. It likely could be who are they talking to, what are the questions they're asking, but the measure from the conference board is a lot more robust. At the end of the day, though, the levels at which they are still show a substantial amount of confidence, even though people are concerned. I think what you have with the government shutdown, I think that has shaken consumer confidence when they think of, well, where does this go if this becomes a protracted situation? It's already, 28 days or 23 days, whatever the heck it is. But my point is that it weakens the sentiment somewhat. People are concerned what happens with China. But at the end of the day, the fact that you have an economy that has seen wages rise, albeit modestly, and people feeling more confidence that they're going to hold their jobs, a year ahead and have an opportunity to switch jobs if they're not happy, that leads us to think that the consumer sentiment is not worrisome at these points.
Eric, are you surprised to see the size and speed of this market comeback from Christmas Eve?
Well, when you look at what's going on in the world, there's really no immediate reason for stocks to go up. You have uncertainties associated with trade. You got a government shutdown. You have Brexit. You have slowing earnings growth here in the U.S. this year. Yet stocks have made a nice move over the last 2 or 3 weeks. And the reason has been that we really got into oversold conditions in individual stocks in the fourth quarter. And in the Hodges funds, we're really going in and finding opportunities in individual stocks. Everybody focuses on the macro and really passive investing, but we think this is the time to really pay attention to individual company valuations, and we're finding opportunities in areas where companies really control their own destiny. There's a lot of things out there that we're finding are really oversold, and we're concentrating those positions in our portfolios.
Do you have a name or two for us?
Yeah, we like commercial metals. This isn't a bet on the steel industry. They just made a transformational acquisition, which we think will be a nice tailwind for the company this next year. We like Cypress Semiconductor. All the semiconductors have been beaten down at this point in the cycle. This represents a good entry point for that stock. We also like Goosehead, which is a dynamic growth story within the insurance space that's relatively unknown out there.
John, is this a time for individual stock picking or follow the broader macro trends with the index funds like has been working for the past few years?
Sarah, we think it's both. It's a little bit of alpha, a little bit of beta. You hedge your plays in there. With alpha, you're naturally going to have a narrower selection. With beta, it's a much broader based play. So if your alpha fails you some, your beta may bail you out unless you get a broad decline in stocks. Similarly, if beta fails you, your alpha may, on an individual pick basis. The whole concept of alpha is just a narrower selection of securities, whatever asset class you're working with, expecting to beat the index. So we like a balance of the two, and we continue to see, at this point, we think it's cyclicals over defensives. We think the market was grossly oversold in the fourth quarter. A lot of it was on negative projection about the possibility of a recession, negatively projecting some weaker economic data into a much deeper slowdown that we think will be realized. And the fact that there was increased concern related to China. You had a precipitous drop in the price of oil from October.
I mean, the biggest change has been the Fed, though, hasn't it? I mean, the perception that the Fed was hell-bent on raising rates and trimming the balance sheet.
The marvelous thing with the Fed got more communicative. Yeah. And that, I think, you had that moment, the televised moment that was Ben Bernanke and Janet Yellen effectively coming out providing support, in essence, to Jerome Powell and trying to say he's going to improve his communications to the market, seems to have let people stop that negative projection of the fact that it doesn't appear to us, and never did last year, that the Fed was gunning to drive the economy into a recession.